All right, welcome back. Friday is going to be a big data day, right? In the commodity world, we're going to get that big WASD report. But in the equity world, it's the kickoff of earnings season. We have them, four of them every year, right? Just quarter by quarter. And we're going to hear from the big banks. That's JP Morgan, Citibank, Wells Fargo, and Morgan Stanley, just to name a few. And besides all the regular metrics that we like to look at, like sales and trading and net interest margin and investment banking, we're going to need to pay special attention to a category that really doesn't get normally a lot of the big headlines, right? A lot of the airtime. And we call those the loan loss reserve accounts, right? The loan loss reserve account is where big banks hold cash to cushion themselves from defaults of the loans that they've given out, right? So over the last year or so, they've been funding those accounts pretty aggressively, trying to protect themselves from defaults. With reports of credit card and auto loans at record highs, you can't really blame them, can you? It's just another way to gauge how strong the bank sees the economy and the consumer and what's coming around the corner. The more they put aside, the worse they think things are, and vice versa. The less they put aside, the better they think things are. So we thought our next guest would have some keen insight into this subject. Please welcome into the show Craig Bolanos. He's the CEO of the Wealth Management Group in Chicago. Craig, thanks for taking the time. Yeah, this is one of those things you can kind of get a little bit of a different picture into how well the banks see the economy and what's coming around the corner. What do you think about that?
Well, listen, I think these loan loss provisions quarter after quarter, 3 quarters in a row now, they've been going up. But I don't think that that should be a massive warning sign to anybody, because we need to remember that because of the CARES Act, because of the American Rescue Plan, there was so much stimulus out there. Loan losses in the banks have been somewhat non-existent. So the fact that the banks are finally using common sense and using the events of March of last year, when banks got caught offsides, to pad their books to make sure they can deal with a slowing economy caused by a stressed out consumer and rising rates, I just think it's responsible. And I look forward to all those bank earnings on Friday telling us what their outlook's going to be.
Okay, so let me move on to another area that is in the same category. It was last March and April when we had Silicon Valley go under. A few other banks got stressed and went under themselves. That's when the Treasury, the Fed, and the FDIC, 3 big guns, came out together, and they put together something where these banks could go to a window and loan themselves money from the government to pad their balance sheets so that they wouldn't suffer a run on the bank, right?
You mean the Bank Term Funding Program that essentially nationalized the banks that no one really talked about?
Yeah. Okay. You see where I'm going with this. Can you mention a little bit of something about that, number one? And number two, I have research that says that every month the amount of money we take from that window is getting larger.
It is. It just comes down to this again. I mean, I love free markets. I don't believe in excess regulation. But didn't people play sports growing up as a kid? And the concept of offside should be resonating with risk control officers all over the planet. But yes, essentially, we created this Bank Term Funding Program to ensure that other banks don't meet the same demise as Silicon Valley, First Republic, in case they're not managing things like interest rate risk. That being said, yes, there's more and more lending being done through the Bank Term Funding Program every single week, which just tells me that there's a lot of banks that had better capital structures. But if we didn't create this plan, there would actually be more tombstones laid about in the spring and summer of last year than we actually ended up enduring.
Right. So these banks took all this capital in from depositors, especially over COVID, and they didn't really have anywhere to go with it. And they're supposed to go someplace. So they couldn't lend it out all at once. So what they did was they bought bonds with that money, right? And that's what a lot of them did. A lot of the Fed pressured them to do that too, right? In doing so, that kept bond prices higher, that kept interest rates lower. However, when we see what happened to bond prices later, when interest rates went from 1 to 5, those prices of those bonds plummeted, putting those banks at risk. That's why they're having to go to that loan window, the BTMF or whatever it's called, to restock their balance sheets so that they aren't at risk like they were before, correct? So cutting rates would also help these folks, right? Because that would mean these bond prices would go back up.
Well, in a way, it's going to help their balance sheets. But don't forget the offsets. 2 quick comments. Number one, these loan loss provisions that we talked about earlier, I'm happy with what's occurring. That being said, number two, let's not forget that NIM, net interest margin, is helping these banks with tremendous profits. And I think that profit from net interest margin is going to be offsetting some of the
Good
loan
point.
losses that are going to come from the consumer. Third, all I can tell you is I'm going to hold up a prop. Thank heavens we all didn't have a whole bunch of these during the Great Recession of 08, 09, because we'd be living in caves. Can you imagine the runs on the bank if we could have moved money with our smartphone back in those days?
Well, that actually makes me laugh because I've said this many times, that these banks feel like a bank run is still going to be a bunch of people standing outside the bank like they did and It's a Wonderful Life. No, people can move money, like you said, with their phone. And that's what a lot of people did. And I think that's how Silicon Valley Bank got caught off guard, as well as a couple other ones that also went down. But I think that's a really good point that you make, that, boy, technology changed the way we have run on the banks, right? You got about 10 seconds. What do you think?
No, that's what happened. Every grandparent FaceTimed their grandchild and said, help me move my money. And that's exactly what brought those banks down. It just goes quick. So I think we're in the same economy, in the same market we were in 2024. It's day by day.
Yeah, I totally agree. Man, that's great stuff. Thank you very much, as usual. Craig Bolanos coming to us from the Wealth Management Group up in Chicago. Craig, thank you very much for your content. Always great to have you on.